So on this channel, I've been consistently promoting working towards high credit limits and putting out videos around high credit limit growth strategies that have been very effective for my viewers and my base. That having been said, it would be literally a disservice to you if I were not to cover the potential risk of having high credit limits on your personal profile, even if they're paid down. I'm going to give you 3 major setbacks or drawbacks that lenders or underwriters could use against you when trying to access more capital or even more important levels of capital like mortgages, business funding, if you have successfully acquired high limit personal credit cards. So the importance of this is to make sure that you understand this in advance. These 3 reasons I'm going to lay out are possibilities I'm going to lay out for you. And they're real. They're not just hypotheticals. They are real underwriting scenarios. And I want you to understand them not to deter you from stacking high credit card limits, because there's tremendous benefits to your finances, your banking relationships, your credit score and report. But just like anything in life, too much of it can turn out to be a bad thing, especially depending on the underwriters or the loans that you're dealing with when you're going back out there. Because the baseline point of high credit limits is to position you with good relationships with banks and lenders to access higher quality, more useful forms of funding. Credit cards are ultimately used effective as spending tools. Some of us have stretched them out to be working capital, but to be completely honest, they're really not the goal in mind. They're just a tool, they're a lever to get you closer to the real goal, which is to access capital for real estate, business funding, things of that nature. So the 3 reasons I'm going to break down for you. Number 1 is going to be what can be perceived as a high borrowing capacity, which normally is a great thing. I say literally like one of my moniker on here has been, helping you to maximize your borrowing capacity. And that stands true because that is a broader blanket statement for your ability to access capital for all means, productive means, right? But when we're talking about specifically high limit credit cards, your borrowing capacity could shoot you in the foot, because what ends up happening is the bank that's underwriting you for that mortgage or that business funding can turn around and assess and say, this person has, $150,000, $200,000 in borrowing capacity. Their limits are all paid down. They look good right now. But, technically speaking, they can end up with a flood of debt at any given time, and it's accessible to them. They already have a decked out capacity to borrow $150,000, $200,000 immediately and end up in debt. And if we lend them, whatever we're going to lend them or could potentially lend them could fall to the wayside or fall on the back burner as the order of hierarchy when it's time for them to start servicing these debts. So the borrowing capacity is the number 1 thing in underwriting when you have high personal credit limits that can shoot you in the foot, because a lender could turn around and just think, damn, that's great. They've been able to manage and get access to $150,000, $200,000 in personal credit limits from credible banks. Their utilization's flawless. Their credit score is high. But what happens if they run into a hardship? What happens if for whatever random reason or said reason, they decide to run up all of these limits? Whatever we're coming in as the secondary or third case lender or the back end lender, while they already have this borrowing capacity, they could turn around and quite easily shoot themselves in the foot, and we can end up holding the bag because they're going to be drowning in so much debt before they can even get to ours. This may not be a good idea. And that's an underwriting, set of circumstances you can run into. Number 1 is borrowing capacity, just the overall idea that you have access to those credit limits. Number 2 is going to be your DTI, which is hilarious in a sense because you having higher access to or higher credit limits in excess, technically speaking, shouldn't work against your borrowing capacity, your DTI, because it's not necessarily active debt, right? It's really just the capacity to borrow. But because of that very reason, you will have lenders who will simulate, even if your cards are paid to zero. Let's just say, again, you got $150,000, $200,000 in personal credit limits, and they're all paid all the way down to 1% or zero, right? You're looking polished when you go to apply for whatever said loan. The lender could hypothetically put minimums, like hypothetical minimums, on those cards and simulate that into your underwriting. They can do that. They can literally say, okay, well, technically speaking, they have $150,000 or $200,000 in personal credit limits. What happens if they run these balances up? What would their minimum payments look like, and how would that play into their DTI? So that's a scenario where it's like, oh, even at 2% or 3% minimum payment on $200,000, they can have this many hundreds of dollars a month in minimum debt servicing. That can be preset into your underwriting and kill your DTI on whatever other form of funding you're going for. And again, it could be purely hypothetical. There could be no limits. It could be completely paid off, rather, on your credit report. But just because of the possibility that you could get there, again, they will simulate hypothetical minimum payments on those cards and really torpedo your deal potentially if they were to do that. So that's number two, is they could look at it and actually skew your DTI on pure hypotheticals. Number three is just an overall risky profile. Kind of ties back into number one, but this one plays closer into if your income and credit limits are too close on par with each other. This is a very common one, and this is a drawback that kicks you in the behind because, like a Navy Federal, for instance, there's a lot of data points of individuals getting 60, 70, even up to the maximum $80,000 in credit limits with them. No documentation required, just going off of the banking relationship and good credit history, good card usage. But they only make, 70, 80, 90, 100,000 a year, whatever. So they have nearly 100% ratio, a 1-to-1 ratio of the credit limits and income, or like a 0.75% ratio or something along those lines that will make a bank uncomfortable because of your capacity to borrow. So even if you don't fall victim to the first two, which is borrowing capacity as a whole, DTI and a hypothetical minimum payment, they can turn around and slap you with the fact and say, you know what, just because you have $100,000 in credit limits and you only make $120,000 a year, you technically have the potential to be at 85% debt, 85%, debt levels of your income. You know what I'm saying? Like some crazy scenario. So your profile literally could be booked or deemed or marked down as risky just because you have access to those high credit limits and they're too close in proportion to your income. This is particularly risky at smaller banks. Like this really stands out at smaller banks. You'll notice that larger banks are dealing at such scale that their underwriting and the tools and mechanisms and the algorithms they're using are different. You go to like regular standard hand-based underwriting at these small banks and credit unions where they're just looking at numbers in black and white. They don't have the scale, or they're not working off of or designing their underwriting under the scale that a Bank of America, Chase Bank, Amex is going to do. Amex and Chase Bank may look at this. First off, you'll have more breathing room to document income with a bigger bank, because they're going to allow you to take everything that's legal. Like literally, you can say you're a hobo and, like put that down on your, your gross income on your application, and it's completely legit. Small banks tend to verify income. Literally, I have a video that I shot not long ago where I talked about how I got hijacked out of, like $12,000 out of a credit approval that I got just because they misread my income statement. And it cost me. They were going to approve me for 20,000 and ended up giving me 8 because the underwriter misread my income statement, and the middleman, which was the branch manager, wasn't at work at the time to mediate to connect with us at that time. So my point is, this was a kind of smaller to mid-sized bank. They still do verification. Like, they still have you submit pay stubs on a credit card application. I know we're kind of spoiled to the Amexes, the Navy Federals, the Chase Banks. But when you get to these smaller institutions, we give them a lot of praise for their personalized service and flexible underwriting, but they tend to do stiffer underwriting because they're not working at scale. So they can't afford to take the level of losses that a bigger bank can and play those games and play those underwriting and algorithm, estimation, guesstimation games that bigger banks can play. They need black and white. They need to see, if you say you make 70, 80, 100,000 a year, they need W-2s and pay stubs to back that up. So the third one can really become a hindrance by the time you're dealing with these smaller banks or smaller to mid-sized banks, because they're going to look at it and say, well, your W-2 says $85,000 a year, but you got $75,000 in credit limits. Normally would be a great thing. It's got your score through the roof. Your utilization has breathing rooms, et cetera, et cetera. But ultimately speaking, it's still debt that you can get into. And for some banks and institutions, that's just not worth it. They will deem you risky. So that's the big three that I haven't seen get covered much in the space when it comes to the credit funding and personal finance space and the business funding space. High credit limits, comparable credit, the utilization benefits, all of these things are tremendous. I still encourage and will continue to encourage building out high credit limit profiles with various banking institutions because it gives you a lot of financial benefits. It gives you great relationship perks with the banks that you're working with. But there's some drawbacks you have to be mindful of and get ahead of before you go for those really pertinent forms of funding, like mortgages, real estate financing, business funding, etc. So I want you to comment down below. Let me know if you've run into any of these given scenarios that I've laid out for you in the underwriting process. Let me know if they kind of opened your eyes up, if you haven't heard of it and it hit a light bulb like, damn, I didn't even think about that. Let me know down below what your thoughts are on these 3 potential underwriting pitfalls of high personal credit limits down below. And let me know what your highest credit limit is and what bank and what institution, what card you have your highest credit limit in, because I've gotten some phenomenal responses on recent videos of some of my pioneers and viewers having tremendous success with banks getting high credit limits and using that to expand and grow their finances into phenomenal places. So comment down below and let me know where you stand. Other than that, to all my pioneers, welcome back. To my new viewers, welcome in. Like, comment, share, subscribe, boost. There's a new feature out there that allows you to boost the videos. Support this channel, support the videos so this channel can continue to reinvest and support you. So other than that, if you want to get in with me on Instagram, the link in the description down below or will be in the description down below. Also, if you want to work with me one-to-one and get a financial professional, a business banker, banker by trade, FINRA license, NMLS, or state mortgage loan originator license, if you want a professional that's decorated with hands-on 10 plus, 11 plus, 12 plus years of experience in personal finance, banking, and lending in your corner, helping guide you to customize your blueprint for prosperity, maximize your banking relationships, etc., get in the description down below. I have a list of areas that I specialize in that I may be able to assist you. Otherwise, you can comment down below if you want to learn more about working with me as well. Other than that, I appreciate every single one of you. I want every single one of you to stay focused, stay in motion. I'll see y'all soon.